Hey, Colorado, Chris Lopez here, and today's podcast is a deal analysis with our strategic partners, Spearhead Commercial Capital. So we've been doing these now for the last 6 months. We've had tons of interest in general about commercial deal structuring, because we all know like commercial lending is very creative and you can pull many different levers in it. But especially now with interest rates doing what they're doing, which is going up, it's become a very different environment. But deals are still being done. Investors are still doing deals. But in this type of environment, lending has become even more important because different lenders, different banks have different programs. And William and Marcus with Spearhead are experts who have the connections, and investors bring them their property or their situation. You guys go out there and find the right solution. So today we're going to talk about an investor who had a lot of multifamily around Denver for decades and then started moving those properties into triple net properties. So some interesting deal structuring and to why the investor is doing it as well. So good morning, Marcus.
Hello, hello.
And good morning, William.
Hey, Chris.
So Marcus, I know you ran lead on this deal. So give us the profile, if you could, of the investor here. They owned a bunch of multifamily for, I think you said, a couple decades, but kind of paint me the picture of their portfolio and kind of where they are in their investor journey.
Yeah. So this is a couple who inherited some multifamily properties, let's call it 30 years ago. So closely held family assets. These guys were operating these properties in Littleton and the Inglewood area, and they saw a wave of appreciation like a lot of folks had, and they took advantage of a sale somewhere around 2015, 2016. They started selling these assets off. And then as a family, they decided they were looking for some more passive type of investments. And for them, they were intrigued by kind of getting a pretty well split portfolio of new triple net opportunities that looked like retail and industrial. Those were the asset classes they were honed in on. So yeah, these guys have done really well. I'd say they have a $25 million valued portfolio right now. And we were taking a look at 3 of their 6 properties.
Okay, 3 of their 6 triple net properties.
That's right.
And so it's pretty common. I mean, a lot of investors, if they own, multifamily for decades like this, for them to start, transitioning into triple net properties is a very common asset class because they go into more like wealth preservation and just a lot less headaches because it's triple net and they have a lot less responsibility. So they've been buying triple net the last 6, 7, 8 years. What were you helping with them on these 3 properties exactly?
Yeah. So, we received an introduction to this borrower about 18 months ago. They were playing the game that's pretty typical in the market where they had some prepayment penalties on their current loans. So their 3 current loans, they had prepayment penalties, but they also wanted to take advantage of the low interest rate market. Remember, this was still a low interest rate market when we were talking 18 months ago. So they were playing the game. There was an opportunity shortly after Christmas for them to kind of pull the trigger and secure a rate that would have had some rate savings for them and would have also been a good time for them to pay off their loan because they were in what was called a swap prepayment penalty.
What is a swap prepayment penalty?
Yeah, good question. So I guess it's a mechanism that's measured off of the treasuries and your loan amount. So rather than just a percentage of your loan being your set fee amount,
like the typical 3% or 2% or 1% of the balance.
Right. It adjusts with the interest rate environment.
Okay.
That's right. And weirdly enough, when the rates go up, your fees go down. And then when the rates go down, your fees go up. So I know
generally the reason for that is because the lender then can re-loan that money at
the market higher rate, right?
Rates,
yeah.
Yes.
That's right.
So it kind of works like how just bonds work.
Exactly. Okay. So they were playing that game, and unfortunately, no one really could have predicted the war that came up at the beginning of the year, and that just sent the interest rate environment into full shock mode. And these guys were kind of in a pigeonholed environment where their fixed rate scenario just wasn't what it was a couple months before. And then now we had to get really creative.
Oh, so let's talk about this because this is where I always find like the commercial world so fascinating is you can get so much more creative on there and there's just so many different types of structuring you can do. So he was looking to refinance and actually pull some cash out. Or like, what were his main like goals with this? Because I know there was a couple things if I recall.
That's right. So the cash out was a heavy emphasis. These guys were W-2 employees at the time of this closing, but they were anticipating retirement. So they wanted to essentially fill their balance sheet with some liquidity. They were in a great equity position, so they had some wiggle room there. And then another priority was prepayment. They really wanted to avoid prepayment penalties. One reason, because of the swap agreement that they were just in and how that kind of compromised their plans. And really, they're planning to sell out their portfolio entirely over the coming years. So they really wanted to have some flexibility around prepayment. So to achieve that, we had talked about lots of different ways to do that. We could do a 3-year fixed rate loan that had no prepayment, but the interest rate was sky high at that time. We were going to be talking about a 5.5 interest rate. And this gentleman had been pro-forming, 3.5 fixed interest rates. So quite a shock in the market and to his cash flow. So what we had looked at is doing an adjustable rate loan. There are risks with adjustable rate loans, of course, because those rates move more frequently and it can change your cash flow drastically.
But you're talking like monthly or quarterly adjustable rates.
That's right. Yeah. So their final agreement was a monthly agreement to adjust, which bargained down their rate quite a bit. It allowed for the no prepayment because usually when you take on an adjustable rate loan, there's no prepayments in those scenarios. So he got the interest rate that he wanted. Of course, that rate has adjusted up since this closing a couple months ago. But it is an idea of how you can get a lower interest rate in today's kind of crazy environment. So
it would take quite a few rate adjustments for him to get to where the fixed rate would have been. So, to the point in the slide, 3.35% is that ship sailed, 9 to 12 months ago.
Yep.
And so, I mean, for that adjustable rate to go up to where a fixed rate would be, they're still coming out ahead.
Okay.
For sure.
So even with like continued interest rate increases, they're still going to be most likely better off.
Yeah. The short rate environment hasn't moved as drastically, although it's still upward.
Okay.
Yeah.
So those are tracking, shorter term interest rates, right? Like it's not a prime based thing. It'd be more like a SOFR, like a 30-day SOFR, which used to be LIBOR. That's a whole different podcast of why it's SOFR now and not LIBOR, but those are just less volatile on the daily adjustment than say, a prime or a treasury rate, right? Everybody knows prime's going up and SOFR sort of tracks to that, but not as aggressively and as volatile as say a treasury would be. Too.
Okay. So I'm putting myself in your client's shoes and, thinking about his goals and debating between, hey, getting a fixed term and getting, adjustable rate mortgage. How did you help him kind of like figure out what the right one was for him? Because imagine there was some modeling, maybe some coaching or therapy in there, it kind of, a lot of times they kind of blend together, but that's like, just one of the great things about working with guys like you is you're able to do that. But I'm trying to figure out, because I could see that being obviously a very important decision, especially going into retirement. And I've had debates like that myself. How do you guys help him figure out the right solution?
Yeah. Oh man.
18 months of pain and
yeah. Lots of spreadsheets actually. Yeah. This is a unique one where this gentleman who has, like I said, a great history and great experience in commercial real estate. So he knows this stuff quite well, which we can appreciate. And then on top of that, he works pretty much as a rocket scientist. So he's very much, thinking on a spreadsheet level, let's say. So he loves the
little analytical.
Absolutely. Analytical, all the way through. So this was a challenge in that aspect because he was always trying to forward predict where interest rates were going. And we never really like to do business that way. We just like to talk about where the environment is actually. But at the same time, I never want to tell a borrower that their thought process is wrong. He's obviously built a very nice portfolio, so it's hard to argue with that.
Yep.
But at the end of the day, it was a cash flow. He kind of worked off of the priorities of getting his cash, which we accomplished, the no prepayment penalty, which we accomplished, and then, keeping his debt service at a manageable place, which he was actually saving money. And I still believe he is on his debt service in comparison to where he was even with the cash out.
Okay.
So he had pretty high interest rates before because that loan was placed, let's call it 5 or 7 years ago.
Okay. So something else about this loan is it's a 3-year term. So after 3 years, it balloons?
Yeah. So
okay.
The bank in this situation, which another thing here is, this was a scattered site type of scenario. Not all of these properties were just in Colorado. So you have to find a lender that can go to these different markets. So that was another layer of
because they were in 3
challenge.
states, right?
That's right.
Yeah.
And 3 different type of assets really too. So
can you tell us the asset in the state? Is that?
Yeah, I don't think there's any problem with that. So in Florida, they had a company, which I think most people would be familiar with, Caliber Collision, which is a nationwide company. And that would be considered pretty much retail, light industrial. And then in Texas, they had an oil and gas service company, which I would say no one's really familiar with because it's not a public company, but it is strong underwriting. And the property was essentially built for this company who's been there for 15 years and signs a 20-year lease. So safe at that aspect. And then the property in Colorado was a learning center, which gets categorized with a lot of lenders as what we'd consider special purpose. Meaning that you can't just reconfigure these properties as easily as you could a traditional office space.
Oh, yeah.
So, but yeah, so pretty unique deal all in all as far as how the loan was set up. Oh yeah, and then on the 3-year term, how that works is the bank just agrees to keeping this loan on the books for 3 years, similar to how they would a fixed term. But for them to get the lowest spread, if he would ask for a 5-year term, they would have had a higher spread.
Okay.
So that was kind of the give and take on that.
And 3-year was good for him because it sounds like he'll probably be disposing the property in that time frame.
That's right.
Yeah. Okay. So this is really cool. So, I mean, he and his wife got obviously a very great situation tailored to their needs and just adapting the market. Like that's, a conversation I have. I'm like, oh, people, I want this. I'm like, great. I realize you want this. Market's over here though.
Right.
Market's not adjusting. Either you need to adjust, we got to find a different market for you. Yep. And so, that's, it's a tough conversation. That's just the reality of like, hey, you got to roll with the punches on there. So I'm curious from you guys' perspective, because I always see like a lot of the, the value that you bring to clients, a lot of the deals we've done together is when an investor comes to you, whether it's a buy, acquisition or refi, they come to you with, hey, here's a situation, here's a property type, here's location. And then it just seems like it's a giant, like, I'll say a matrix for lack of better words. You guys compile that, underwrite, and go out there and talk to, a bunch of lenders in your network. And you're just out there trying to play matchmakers who's got the best product at that time for this scenario, right?
That's right.
So
and it's ever changing today.
I imagine like in this current environment, it just got to be even like just way, way more difficult or I guess more fluid.
Difficult's a good word. I think there's challenges in the market. How William and I are spending a lot of our time is just getting updates from our lenders, right? Somebody who was really competitive last month might not be this month. And I think that's the game that we're playing right now for a lot of folks. You're right. We're always taking people's priorities and that's where we lead to the market. But then we also want to be realistic with folks.
Yeah.
This priority probably can't be achieved if we really have to get, say, both of these priorities.
There's a lot of managing expectations around where people think things are and where things really are. And then really trying to make sure that what we put out there from our lenders is going to be deliverable for the next, really 45, 60, maybe even 90 days for an acquisition type of transaction. And, it's challenging because as rates go up, lenders are constantly afraid of putting something in the books today and then being underwater on that in 12 months time, just because of the trajectory of interest rates. So, there's a lot of that conversation going on.
And I mean, do many of these lenders, as you're talking in the early stages, will they lock in the rate or it's like, hey, here's that is today, but Fed meets in 3 weeks. So may change.
I wouldn't say many.
Yeah, not very many. I mean, if you
Not many do a rate lock.
Exactly.
Yeah, okay.
I mean, and if they can, it's going to be kind of pricey
Because you'll pay a premium for that insurance policy, essentially,
in most
right?
cases, for sure.
Okay.
Some lenders do just kind of honor term sheets that they put out there for a specific period of time. A lot of them used to do 90 days, and they've trimmed the fat.
90 days is a long time right now.
Sure. So 60 days, I would say, is something that they'll commit to. But anything longer than that, and if it's a swap type of product like that, that's costing money on the front end.
Okay. So kind of taking a step back from this deal, but just taking all your guys' knowledge and experience in doing deals like this, any just general tips or advice or things investors should keep in mind who are in a similar situation as to your clients here as they were transitioning from multifamily triple net is part one. The question part two is just looking at some like refinance opportunities. Like any additional advice you would like to tell investors out there? Because I know this is a fairly common situation.
Yeah, I think the triple net stuff is a lot of fun to explore, especially if you're not seeing the value in the different asset classes right now. This is kind of a predictable cash flow, which you can't say in a lot of asset classes, just how the lease is designed. So I think a good place to start is looking at some publicly traded companies that you can actually dig into their financials and see their quality of financials and ability to perform on their leases, because what you're going to see is you might see a 20-year lease, which is a beautiful thing if you just like to sit back and know what your predictable income is for the next 20 years, let's say, and they're responsible essentially for everything in your building. So that would be a fun place to start. And there's a lot of brokerage groups out there that just specialize in triple net.
Yeah.
And those are good groups to lean on as well, of course, as far as transaction brokers.
Yeah, I mean, we've seen a lot of that. We've got a couple of clients right now that are transitioning out of, multifamily, selling out of those at, compressed cap rates, right? 4.5, and then chasing yield on triple net, industrial retail type of assets. And they're getting in at, 6 to 7 caps. And those are just step up leases. To Marcus's point, can be 20 something years long. And you just can see where your exit or where you're building up to in terms of, cap rate and return. So I don't know, that's kind of a fun conversation for people to look at as it relates to their own portfolio. One
of the things that I've, look at, hey, 20-year lease is great, but if you got a fixed, 3% of your increase, that's great when we're not at 8.6% inflation. And I have never underwritten for high inflation like that. And I've never done it from like a long-term commercial lease because that's not my specialty. But I'm curious, is the inflation rate and looking at these long-term leases, which I think from the few I've seen, their annual increases are far below 8.5% a year in increase.
Yep.
Is that changing the way lenders are underwriting a 20-year lease or the way they're underwriting a property?
I wouldn't say so, because the cash flow is still the cash flow and the debt obligation is the debt obligation. So I think where they would be wary is, okay, it's a manufacturer and their costs are going to go up because of X. Then I think you could really start getting nitpicky about that. Typically how these are, especially a deal this size, let's say with full personal guarantees and a lot of equity in it, they're really relying on the personal guarantee and the equity in this situation to get comfortable with it. Now, those are all tenants that we're familiar with, at least the bank is. So there's a comfortability there as well. So I think it does go back to the tenant. It goes back to the deal size, industry, although we're talking about a specific type of lease. So I think all of those are going to be factors going forward. It's a great question. We don't see it coming up when we're underwriting deals. But it doesn't mean that on the back end, and if we're talking about a $50 million portfolio of just some manufacturer of steel, let's say, and they have 20-year leases, and I think there's a conversation to be had about what you mentioned with inflation.
Okay. Because I haven't talked to any lenders about that. I've heard a few investors kind of bitch and moan about their, like, oh, great, my increases right now, it was really good 5 years ago, not so great at the moment.
Isn't that crazy?
Not that, but it's been interesting how that's changed. I never thought about the inflation risk involved in that.
Yeah, we never talked about that.
Yeah.
No, it doesn't really affect anything other than that's what's chasing rates up, right? I mean,
Yeah.
the Fed's trying to catch up or right size inflation by doing these massive increases to short-term overnight interest rates. And that's why you see, and that will continue until, or so they say, will continue until inflation's under control. But and that's what affects our world is no one on the lending side is talking about the inflation other than that's how interest rates keep charging forward.
Okay. That makes sense.
That's a great point though.
Well, awesome guys. As usual, great podcast, really cool deal as well. So I want to make sure people can reach out to you. I know you guys have been doing some work on the website, some CRM stuff. So what is the best way for people to reach out to you? What's the process for people to explore their situation, their property with you guys?
Yeah, LinkedIn can find us pretty easy at Spearhead Mortgage or Spearhead Commercial Capital. And then our webpage, spearheadmortgage.com. We have a contact us page and it is up and running and we'd love to hear from people.
So go there, fill it out, or shoot you guys an email, give a phone call and just kind of go through the process.
Yeah, it's not it's a pretty easygoing conversation in all reality. You know, we can only help people that we can help. And we can confirm with you that you either have a good deal or we can't help you or we can't, so it's a pretty straightforward conversation and the numbers tell the story in a lot of situations. So
yeah, I know it's some legwork on the front end to submit a contact us thing through our website, but it really does help us if you have kind of an active project that you're working on that you can give us some details or give us a scenario to talk through. That helps a lot. It'll be more, informative for you as an investor to give us some details on the front end, and then we circle up via call. That way we can do a little bit backroom underwriting and market analysis on at least that market or that specific property. But yeah, always happy to talk to people about what we're seeing and how it relates to their situation.
Perfect. Well, Marcus, William, thank you guys so much. Love being on the podcast. Can't recommend you guys enough. We've done, a bunch of deals with you guys. All we've heard from our agents, our happy agents, our clients and your clients, they've all been happy as well. So if you guys need commercial lending needs, definitely reach out to these guys. They'll take care of you.
Yeah, thanks, Chris.
Awesome. We'll see you guys next week.
All right.
Thank you.